Hello, everyone. In financial modeling, one of the most common and frustrating issues is when the balance sheet doesn't balance, meaning there is a mismatch between total assets and total liabilities and equity. In this episode, we will examine what the causes might be and how to solve them. Generally, there are 3 preparation steps and 4 sources of error. Once we understand these, we can start solving the problem. Now, let's start with the 3 preparation steps. The first step is that we need to create a backup copy of your file. This helps protect the original model while you troubleshoot. The way to do it is to copy the original file and then rename the copied file. For example, here, I changed the name to test. Remember, this is the file to be modified. Do not change the original file, unless we have identified the cause of the problem. The second step is to run a 2-stage balance check on the balance sheet where the values do not match. In the first stage, we calculate the difference between total assets and total liabilities and equity. In the next stage, the balance difference is compared to the difference from the previous period by subtracting the previous period's figure. This helps you spot patterns and identify where the imbalance is coming from. Then, the last preparation step is to highlight identical values from the starting year. This helps us narrow down the sources of problems more easily, so we don't have to get dizzy staring at each number one by one. Especially if we're making a balance sheet for a big company with long and detailed records. This step is really useful for saving time. One thing to note is, make sure the initial balance sheet we create is correct. If it's already off from the start, the following years won't match either. Usually, the initial balance sheet is easier because for a newly established company, it's very simple, just investments and funding sources. For already operational companies, we can use the financial statements provided by the company. If the initial balance sheet given is already unbalanced, then it means the accounting department made errors in recording. Ask the accounting team to fix it, because it's not my business. Alright, now let's get into the 4 sources of problems. The first mistake is div by 0. This happens when a formula divides a number by 0. It occurs if we don't anticipate the formula by adding extra functions like if and is error. So, when you enter a number with a value of 0, the calculation breaks. Remember this. Don't blame the person entering the numbers, because in real life, conditions can vary. We, as financial model builders, need to anticipate it by including additional functions. If you don't know where the 0 came from, we need to track down the cause using Excel's formula auditing feature. We select the problematic cell, then trace the source by choosing the Formula tab and clicking on Trace Precedence. From there, we keep following it until we find the root of the problem. The more complex the model, the longer this process takes. Once we find the source, we can prevent issues by adding extra functions like if. That way, in the future, if someone enters a 0, the calculations won't break. The second mistake is a reference error. The symptom is that REF appears in the calculation results. This happens because someone accidentally deleted a column or row in the financial model, even though that cell was being used as a reference in calculations. So, when that cell is gone, a reference error occurs. The first thing you need to do is find the cell with the wrong formula. You could use formula auditing, but that takes too long. An easier way is to use the search function with Ctrl+F. Then enter the hash sign, REF, in capital letters, and an exclamation mark. Make sure the search option is set to formulas, then hit Find All. The results will show you the cells with wrong formulas. After that, you just need to redo the calculation formulas. The third mistake is when the balance sheet shows a 1-unit difference consecutively in the check balance calculation we made. This happens because Excel accidentally fills the auto series when we drag numbers to the right. The solution is to find numbers that were entered without any formulas in the model we created, and then fix them. To prevent this in financial modeling, we can anticipate by coloring numbers entered without formulas in blue. You can also get used to this habit, which makes checking easier. Also, inform users of the financial model which cells they can tamper with to input numbers, for example when changing financial assumptions. Make sure other users don't mess with cells that have formulas, as it could ruin the overall calculation. Also, keep in mind that sometimes there are hidden rows when you drag to the right. So, make sure all the rows are shown using the unhide function. Sometimes the rows are hidden, and we don't realize that some numbers are filled in automatically. The fourth type of mistake is errors in the basic elements of a financial model. If you want to know what these basic elements are, you can check out the previous episode. Usually, the main issues come from depreciation and amortization, working capital, debt and interest calculations, and total equity. To fix this, we use the delete and undo combo buttons. We just keep repeating this. If there's more than one error, we delete them all with the delete button. Make sure to do this on a copy of the file that we've prepared, guys. Don't do it on the original file, or it'll be a hassle to restore the calculations later. Basically, we're just removing parts of these calculations, so that this year's numbers match last year's. For example, depreciation expenses are deleted and there's no change in working capital, so the numbers stay the same from year to year. As a rough guess, usually the errors in the depreciation section follow a similar pattern in the balance differences. But still, we need to check each one. Once we figure out which parts are wrong, try correcting the calculations. If the balance sheet already balances, we can apply it to the original file, or if you don't want to go through the hassle, we can just make this copy as a new original file, maybe by adding a name, like calling it version 2. In conclusion, here's a summary table of the 3 preparation steps and the 4 sources of problems we've discussed. That's all from me. I hope this helps you troubleshoot unbalanced financial models. If any of you have additional solutions or work experiences related to solving this problem, feel free to share them in the comments. It would definitely be very helpful for all of us. That's it, and thanks for watching this video. Cheers.